On today's Hot Sheet, I'm discussing this fall's emerging markets and updates on jobless claims, GDP, and mortgage applications. Today is Thursday, October 26, 2023. I am Byron Lazine, and the Hot Sheet starts now. Glad to be back in my seat here on the Hot Sheet. Thank you, Lisa Chinati, my co-host, one of my co-hosts for the Knowledge Brokers podcast, for taking my seat yesterday on the live show. Let me know in the chat if you enjoyed Lisa Chinati, if we'd like to see her back in the future here on the Hot Seat. But I'm glad to be back in my Connecticut studio. Let me know in the chat, in the live chat, if you are, which market you are tuning in from, if you're joining us live. Get the most out of our content by joining BAM, of course. BAMX rather. You can use the link down below and code HOT to get 10% off in joining BAMX. The market has not cooled off, which is why buyers are looking for emerging markets, a market where they can save on their investments or their purchases. In an 8% mortgage world, a world that may even go higher in the future, it's really important for buyers to pick the right market today. If you're a real estate agent and you hear one of these markets that I'm going to cover, you may want to really promote this as a fact, as a reason for people to move to your market, as an opportunity to attract more interest into your market in what we are living through, the most unaffordable market of our time. The Wall Street Journal and Realtor.com Emerging Housing Market Index is out, just released, and I'm going to go through it with you, okay? What does this market, or what does this index actually mean? We're going to go through the 20 emerging housing markets. It's from Wall Street Journal, Realtor.com again, and they identify markets offering a lower cost of living, number one, including for homes and strong local economics. Okay, so lower cost of living for the actual home as well as for the economics. These markets are characterized by affordability, affordability, thriving local economics, and these lower cost of living. Okay, so let's go over to the data here, and I'll just start going through the list. And let me know in the chat if you serve one of these markets. Number one on the list is Topeka, Kansas, a population of over 225,000, an unemployment rate at 2.9, which is below the national average. So that's good news there. And a median listing home price of $250,000. Goshen, Indiana. Talking about Indiana a lot as having opportunity. The state seems like there's great opportunity. Now the unemployment's higher than the national average at 4.3. They have a 280,000 median price point. These median price points you're seeing here near the top are lower than the national average. Oshkosh, Wisconsin, 317,000 median price point. Fort Wayne, Indiana, 312,000. Lafayette, Indiana, 293,000. So there's your top five. Three of the top five are in Indiana. We've seen this trend before. Okay. Then to make out the top six, you have Racine in Wisconsin, Manchester, New Hampshire, Concord, New Hampshire, Columbus, Ohio, and Johnson City, Tennessee. That makes up your top 10. Moving throughout the list, you have Kingsport, Tennessee area, Jefferson City, Missouri, Springfield, Ohio, Santa Maria, California on the list, despite their 1.9 million median price point tag. Dayton, Ohio at number 15, Janesville, Wisconsin, Canton, Ohio, Knoxville, Tennessee. And then to round out the list, 19 and 20, you have Hartford area in Connecticut, and then Worcester, Mass area in Mass, Connecticut line there. So those are your top 20 emerging markets right now. A lot of Ohio, a lot of Tennessee, a lot of Indiana on the list. So let me know if you're serving one of those markets. If you're serving one of those metros specifically, this is an opportunity to let people know that they can find an affordable economy. They can find an affordable home in your area. So the only one that's kind of sticking out there is that Santa Maria, Santa Barbara, California. I'm assuming the 1.9 there is more affordable than the surrounding areas, or more attractive than the surrounding areas. That's the only one that really stuck out on a price point. The highest price points on the list after that was Manchester, New Hampshire, and Concord, New Hampshire, at 535 and 550 respectively. Everything else was in the fours or mostly in the 300s going through the list. Okay. Price growth and inventory. Price growth in these emerging markets outpaces the national average with a average increase listing price of 19% among the top 20 markets compared to 9.5% nationally. Inventory scarcity has kept upward pressure on the home prices in these markets. So despite there being a more affordability, these prices are moving up quickly as people are seeing the opportunities. The Blue Collar Agent, love the name, brother, serving Knoxville. And I've been crazy busy and had to hire administrative help. I'm definitely leveraging my city and its benefits both on, so check out the Blue Collar Agent if you're looking for local tips on how to leverage YouTube and social platforms. He says he's doing that in Knoxville market. So congratulations to you, brother. Mid-size markets. Many of the top emerging markets are mid-size metros, okay, with populations smaller than the top 300 U.S. metro areas. These markets offer lower costs of living, shorter commute times, and stronger job markets. So these mid-size markets, this might be an opportunity if you're outside of the top 20, but you're like, I'm pretty similar to some of these markets. I'm in a mid-sized market. For you to do a little bit of local data research and maybe compare yourself to the emerging markets. Hey, XYZ town, XYZ metro didn't make the top 20 emerging list. Here's why we should have, right? And list out those reasons in a long form study for your community that you can break out for bite-sized content. A little bit of marketing tips here, Bobby, today on the hot sheet for those agents who are looking to attract interest into their area, especially if you believe you've got an option. If you believe you have an option, an affordable option right now in your market, as we sit here in October of 23, the most unaffordable month in history of real estate, then you really need to scream that from the mountaintops. A city spotlight for number one, Topeka, Kansas, top ranked. It offers affordability compared to nearby cities. So be thinking, if that's you, we're offering affordability compared to those nearby cities. I'm assuming that's the same for that California area, Santa Barbara. The median listing price in Topeka was $250,000 in September. It's a 42% discount compared to the national median. How about that? If you're in the 250, 100,000 median price point in your market, you are a 42% discount compared to the national median priced home. Also, another way of saying that is the payment is half the payment of what the national average mortgage payment would be. Taxes and insurance obviously would have to be similar in that example. But rule of thumb, about half of the mortgage payment to get the median priced home. Bobby, Topeka, Kansas, BAM HQ. You're looking for a home?
Tell me twice.
Have you considered Topeka in your future, Bobby? New markets that have entered this top 20 that were not previously in there were Racine, Wisconsin, Concord, Springfield, Ohio. That Santa Barbara area was new to the list. Dayton, Ohio, Janesville, Wisconsin, Canton, Ohio, Hartford area, and Worcester were the areas that were not on the list for emerging markets and now are. The median price in California is $758, according to the Motherlode with Brad. So there, you may not highlight the median price in California being, double up of what the national median price point is. But let's take that number, 758,000 median price point in California. Now, if you're in a California community that is serving national average price points, 400, 500,000, you could do the same thing. Hey, 40% below the California median price point, the same thing that Topeka, Kansas can say versus the national median price point. And this is why knowing the macro data that we cover here on the hot sheet each and every single morning is important. So you can grab some of these charts if you're a member of BAMX. You can get all of the sources all in one place as a member of BAMX. Link down below, code HOT to get 10% off. You can grab this macro content, do a study on your market, and show the benefits of your market versus some of these scary national numbers they're scary because they're just real. They're the truth. It is what it is. But you can show the benefits of why somebody should buy in your market. A place like Topeka, Kansas, never been there, but just knowing how much it costs to build homes, $250,000 in the next 10 years is probably going to look like $350,000 there. Is somebody saying I'm pronouncing that completely wrong?
No.
Okay, because Racine, I'm going with Racine. It could be totally wrong on that. It's between Chicago and Milwaukee, longer commute, but there's a better home value there. I love these areas. I just was introduced to a part of the country. I haven't been there, but part of the country called Greenville, South Carolina. By the way, if you're a Greenville, South Carolina agent, reach out to me. Love to connect with you. Might have something for you. But Greenville, South Carolina, between Charlotte and Atlanta, obviously a longer commute if you got to go there every day. But similar to what you're describing there about being between Milwaukee and Chicago, okay, you're probably not going to them every single day, but having access between major cities, major metros is an advantage. Okay, maybe you got to get there 2 or 3 times. Bobby's looking at me. I mean, he's in Long Island. He's got to drive over to Connecticut once a week when he's not in San Diego as we were earlier in the week. Okay, so being able to access an hour and a half out, maybe even 2 hours out, for once a week or for business opportunities in these smaller metros, but having a lower cost of living, a better lifestyle for you and your family can be a huge advantage. Okay, let's move on to what's been an advantage for the economy, maybe for people who are earning a living right now, but not an advantage for our fight against inflation. Okay, it is the weekly jobs claim update that we give you here on the hot sheet every single week. So we've got the release from the Department of Labor, and in the week ending on October 21st, the advanced figure for seasonal adjusted initial claims was 210,000. Okay, so this is not similar from previous reports. 210,000 on the initial claims here for unemployment weekly claims. Logan Motoshami from Housing Wire has told us over and over again, we've got to break 350,000, he believes, on this number for inflation really to drop on this last mile. Okay, these recognizing rent prices in the reality would also help that quite a bit. But if you got initial claims to break up over 350,000, that's where you'd see much closer opportunity to get to 2% in his view, which would also probably bring rates down pretty quickly. An increase of 10,000 from the previous week's revised level. The previous week's level was revised by 2,000 from 198 up to an even 200K. The 4-week moving average is 2075. So jobs there hasn't been this huge movement on jobs of unemployment going up dramatically at all. The advanced seasonally adjusted insured employment rate was 1.2% for the week ending October 14th, unchanged from the previous week revised rate. The advanced number for seasonally adjusted insured unemployment during the week ending October 14th was just under 1.8 million, increase of 63,000 from the previous week. Okay, so here's the chart there, the moving average and the weekly as well. Really, it's just been bouncing between that 2 and 250. We got up in the summer, close to 250 there towards the middle of the summer, and we've pulled right back down to that line of 200. Seasonally adjusted insured unemployment. There you go. Not much change there. Up a little bit year over year, but we're not talking about anything significant. We're not talking about sharp increases at all on unemployment. Unemployment, it sounds weird to say, hey, unemployment goes up, good for inflation, but it makes the Fed's job much easier. By the way, next week, make sure you're subscribed to the channel here, hit the bell, especially if you're interested on what inflation is going to do or what the FOMC, the Fed's reaction to all the data on inflation over the last 30 days and what they're going to do to the national rate. We'll be covering that next week. They meet on October 31st and November 1st. I think the 31st is Tuesday, and then the 1st is Wednesday. So next Thursday's show, a week from today, we're going to break down every word that comes out of Jerome Powell's mouth on Wednesday afternoon. We will have key notes and key timestamps, as we always do, for every single moment Jay Powell mentions housing, real estate, mortgage. We're going to break that all down here next week. So make sure you're subbed up and hit the bell so you get those notifications. The U.S. GDP, another indicator of how strong the economy is. Well, it grew at 4.9% annual pace in the third quarter. That was better than expected. So those enormous projections that we had, one of them was up over 6% from Dallas Fed at one time. Some of them were as low as 2.5%, comes in the middle of these projections. It also beats what the Dow Jones had been looking for, which was 4.7% acceleration. If you hear numbers like 4.9% growth, GDP in a quarter, in any given situation in history, as you're tracking the economy, like, this is incredible for the economy. It doesn't help us against the fight for inflation right now. So one could argue that it might just not be that incredible given, the situation that we're in. The sharp increase came due to contributions from consumer spending. This is where I get worried. It's like, okay, the economy's growing and we're just spending and our savings are depleting and our credit cards are increasing. Alex, located in Northwest Indiana, 1 hour less from Chicago. It's the only part of Indiana in Chicago's time zone. Congratulations on the time zone there. Great family market, amazing school, safe, affordable, and awesome lifestyle. It seems like Indiana is the opportunity for investors because it just keeps coming up. Not only is an emerging market like we talked about at the beginning of the show, Alex, but it just keeps coming up as having a price point well below the median average. And Pat McAfee is he's in Indianapolis, so that's another feather in Indy's cap. Consumer spending is measured by personal consumption expenditures increased 4% for the quarter after rising just 0.8% in quarter two. Gross private domestic investment surged 8.4%, and government spending and investment, of course, went up. Government spending, of course it did, to 4.6%. That number seemingly never goes down. Spending at the consumer level split fairly evenly between goods and services, with two measures up 4.8% and 3.6% respectively. The GDP increase marked the biggest gain since the fourth quarter of 2021. So huge gain. All this market uncertainty going on, been talking recession endless for months, not here on the hot, just in general. The general theme is when's this recession going to officially start? How long will it be? Or are we going to have a soft landing? With all of that going on, GDP just absolutely ripped. Consumer spending is what's driving this market. Now, consumer spending is not a great thing. We've seen the last time we saw a consumer spending report a couple of weeks ago, we saw the 10-year actually react negatively to that news. Hey, the consumer's strong. They're spending a lot of money. What happened? The 10-year shot up on that news. The 10-year today is up. We'll get to exactly where in just a minute. Okay, so the 10 years up. Let me just take a quick look here what the market is doing. The Dow's not doing anything. S&P and NASDAQ are both down here to start the day based off of this news. Investors shouldn't be surprised by this, obviously, given the reports that we've had on consumer spending recently. And let me just here's a quote from Jeffrey Roach, chief economist at LPL Financial. Investors should not be surprised that the consumer is spending in the final months of the summer. The real question is if the trend can continue in coming quarters. And so Jeffrey Roach, chief economist at LPL Financial, thinks not going to happen. Of course, we do have the holiday season coming up here just around the corner. What is not around the corner, it seems, is a mortgage application increase. The mortgage applications did decrease again in the latest Mortgage Banker Association weekly survey. So mortgage applications decreased 1% from 1 week earlier, according to data from MBA, Mortgage Banker Association, and their survey, which ended the week of October 20th, 2023. The MCI Market Composite Index is a measure of mortgage loan application volume, which again did decrease the 1% on a seasonally adjusted basis from 1 week earlier. On an unadjusted basis, the index decreased 1% compared with the previous week. The refinance index did increase 2% from the previous week and was 8% lower than the same week 1 year ago. So 2% from the week earlier in a higher rate this tells me, hey, some people do need to go out there and access extra capital, even at this higher rate. The unadjusted purchase index decreased 2% compared with the previous week and was 22% lower than the same week a year ago. Here's the quote from Mortgage Banker Association Vice President Joel Kahn and Deputy Chief Economist. 10-year Treasury yields climbed higher last week as global investors remain concerned about the prospect for higher for longer rates and burgeoning fiscal deficits. Okay, mortgage rates followed treasuries higher, with 30-year fixed mortgage rates jumping 20 basis points to 7.9, highest since 2000. Of course, we know that. And let's take a look at where the 10-year is officially here today. It is actually ticking down a little bit. It was up to start the morning based off of the GDP news, and now has come back down just a tick, but we are up over 4.9 at 4.921 on the 10-year Treasury. The 30-year fixed rate yesterday did indeed get back up closer to that 8 marker at 7.98. But we've been living in this 7.9 plus world here throughout the week after experiencing our first 8 plus handles last week. Later today, we'll get the Freddie Mac 30-year fixed weekly survey. I expect that to be higher than the 7.63 on the weekly survey that we saw last week. I'll give you that number on tomorrow's free format Friday show. Just keep in mind, if you missed yesterday, Lisa Chinati did the hot sheet. Goldman Sachs does have their projections right now of a lower interest rate in the future, but not by much. Okay, 7.3% in quarter one of next year, 7.2%, 7.1%, 6.8%. So holding strong around 7 all of 2024, according to Goldman Sachs, and then 2025 just 6.3. What do you not see in there? We're never going to experience in the near future a 2.5, a 2.75, a 3, a 3.25, a 3.5, a 3.75, a 4, a 4.25. Those aren't happening. Don't be that agent that says, hey, marry your wife and the house and the girlfriend, and then date the rate, and then whatever the hell they say, these cheesy lines. Don't say that. Say, hey, Mortgage Banker Association, Goldman Sachs, with their forecasts, are all projecting a higher interest rate for longer. They've been wrong in the past. They could be wrong again. But based on the 10-year, I would actually be higher than these numbers. So 7% would look good next year if that were to be the case. All right. There's your hot sheet for today. Love for you to subscribe here to the channel. Hit subscribe and hit the bell. We're looking to get over 18K here on the channel before the end of the weekend. So if you could help us out with that, we'd really appreciate it. We'll see you back here on the hot sheet tomorrow. I'll be in my Naples, Florida studio. We'll be live. It's a free format Friday. Love to take your questions. If you have questions for me, send them in, or you can always call in tomorrow on free format Friday. Until then, toodaloo.